You're about to hear my conversation with John Cook, portfolio manager and co-head of Mackenzie's Greenchip Boutique. Today, we'll talk about energy as a national security imperative, the role of renewable energy in feeding the world's current and future needs, and we'll get into specifics of the Greenchip approach to investing and the opportunity set the team sees right now. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Vansi, head of portfolio construction. Today, I'm joined by John Cook, Senior Vice President, Portfolio Manager, and co-head of our Greenchip Boutique. John, thank you for joining the podcast today.
Hi, Raj. I'm glad to be here.
Excellent. Now, John, I'm going to get right into my questions. For my first question, it's going to be on the topic of geopolitics. Now, geopolitics and specifically armed conflict have defined the investment landscape thus far in 2026. And as a result, energy as a national security imperative has been front and center for many investors. In a moment, I'm going to ask you some questions about renewable energy, but first, I would like to take a step back and get your perspectives on the world's growing need for energy.
Let me try and clarify or paint a picture of the size of our energy complex, and then I'll talk about how it's changing. First, I could talk in terms of joules or terawatt hours, and everybody would get really confused. Just think this way, that it is an unimaginably massive machine that extracts and turns energy into usable forms. About 80% of global energy currently comes from fossil fuels, about a third each of coal, natural gas, and oil. And there's some changes within those three. Our global oil demand seems to have, it's growing a little bit, but it's kind of flat. Think of coal demand as flat, but probably starting to decrease, and natural gas increasing. And the reason natural gas is increasing is because it's very important to stabilize the grid as we turn primary energy that I'm talking about into electricity. The other 20% comes from a number of sources. A good chunk of that, surprisingly, comes from biofuels, but the balance comes from what we call low carbon energy. So nuclear, hydro, wind, and solar primarily. And so think about this primary energy, this giant machine. It's growing and has been growing at somewhere less than 1% a year for the last decade or two, a little bit less than the growth rate of GDP, while electricity demand had been growing just over 2% over that time period. In the last 2 years, it's taken off and is now growing slightly above 4% a year. And before we get to specifically what the electricity system looks like, think at 4% a year that we have to double the electricity system to meet global electricity demand in 20 years. It's a massive undertaking and an incredible investment opportunity.
Interesting. Now, as my follow-up question, you indicated there's been a step change in the level of electricity demand, and that sounds like it's going to continue for decades. Sounds like the right time for me to get your thoughts on the role that renewables are going to play long term in helping to meet that demand.
Yeah. And when we talk about renewables, we're really talking about wind, solar, and hydro. And then when we talk about low carbon, we include nuclear in that. And there's some other forms of renewables, but that's the energy set that we're mostly dealing with. Renewables have been increasing as an overall percentage of the electricity generation that we have. The fastest growing part of that has been solar, and the second fastest has been wind. In fact, of global capex going to electricity generation over the last couple of years, wind and solar have taken up about 90% of that. Think of hydro for a minute. Think of like in Quebec, you're not going to be able to double the amount of hydro generation, whereas you can easily grow wind and solar at much faster rates. So low carbon or renewable energy in terms of capacity, the ability to generate electricity, makes up over 40% of capacity. And in terms of generation, it's about 30% of generation.
Very interesting. Now, I am curious. Now, when we talk about energy security as Canadians, we pay very close attention to the United States. Currently, we have a conflict in the Middle East. Earlier this year, there was an armed operation within Venezuela. But you've been in this space for decades, over 20 years, and I know you've spent a good amount of time understanding how China is working to solve its energy needs. And there's been real work put in over the last couple decades, and you've even spent time, a considerable amount of time in the country. What can you tell us about how Chinese policymakers have approached meeting the growing demands for energy in that country?
It's a really, I think, important lesson or model for us all to be paying more attention to and considering. I say us all, like all countries around the world could take a look at China. It's been very thoughtful and strategic, in my view, about how they've been transitioning away from fossil fuels to electricity, and particularly renewable electricity. That doesn't mean they're not using more fossil fuels. Like 25 years ago, they were using about 4 million barrels of oil a day. Today, they're using 16 million barrels of oil a day, and they're using more coal this year than they used last year. But the growth in renewable energy is absolutely stunning. And the reason they did this is an energy security concern that goes back 25 years. They were worried at the time they weren't able to produce that 4 million barrels a day. They weren't able to produce that themselves. They could only produce about 3 million barrels. They were a million barrels a day short. And they were worried about a US blockade, likely in the Straits of Malacca. And they decided it was time to electrify their economy. And so that 10th 5 year plan, China has these 5 year plans. They made, set a number of goals around electrification. And without going through each of the 5 year plans, where they're at now is absolutely stunning. They produce over 90% of the solar equipment in the world, at least half of the wind equipment. And their installation rates are, last year globally, we would have installed about 500 gigawatts of solar. China would have accounted for 250 to 270 of that, so more than half. And definitely there was about 170 gigawatts of wind. They accounted for more than 100. I'm just trying to give you an idea of what a major player they've been in terms of installation. And then to bring it back to where I started, just think where they would be at in terms of their consumption if they hadn't made this strategic shift to try and move to electrification. It takes many, many decades to for us, any economy, to transition away from fossil fuels these days. And I think they provide a great model. And just if I might just carry on for 1 second, it's not just the renewable equipment, but 5 in 10 cars now sold in China are EVs, electrified vehicles. They have, over 40,000 kilometers of high speed rail when, in the United States and Canada, for instance, we're struggling to build hundreds of kilometers. They've built enormous amounts of high voltage transmission infrastructure to bring renewable energy from places like in their northwest down to the industrialized areas in the south and the east. So it's just been very strategic and very thoughtful. And I think we could all learn from the path that China's been on.
Excellent. Now, these comments you have on China, John, I've heard some of your recent remarks. We've been on the road recently, and you've had really interesting insights with regards to the UK. We're talking about energy security, and you've used the example of the UK and their current energy needs. Why don't I let you go through the thesis? Because it's really interesting.
The reason that I talk about that is just an example of what I'll call middle powers. So you've got the United States on one hand, as you said, with a little bit of energy resource imperialism going on year to date. You've got China working in this 25-year transition that I just discussed. Then you ask yourself, well, what about all the other countries that are in the middle powers? And the UK is a really good example because it faces a number of forced energy transition issues. So the UK relied for a long time, as many would know, on coal. They shut down their last coal generating plant a couple years ago. They relied on natural gas coming from the North Sea. Those reserves have been in pretty significant decline. So the UK now imports 66% of the natural gas that they use to run their electricity generation, gas electricity generation. They increased just over 15% of electricity directly from France, which is primarily coming from nuclear. But the reality is that natural gas that they're importing, that LNG, is getting more expensive because of geopolitical events and the costs of liquefying natural gas. France needs their electricity. So, how long can they continue to import it? So, what are their options? Well, they could build more nuclear, but it takes a long time. They have 9 operating nuclear plants. They're all operating past their expected lifespan. So they have 2 new ones. One is called Hinkley Point and the other is Sizewell C, under development, but they won't come online until the early to mid 2030s. It takes 15 years to build a new nuclear plant. So what they're really leaning into, given this complex challenge that they face, is offshore wind, particularly up in the north around Scotland and to the west of Middle England, a place called Doggerbank, and a 2,000-kilometer high voltage program to build transmission to bring that renewable electricity down into the center and south parts of England. And it's just the perfect example of a middle power trying to rethink where it's at in the energy transition. Poland, France, Germany, they all face their own unique challenges, but England offers a lovely example of how they're going about it.
Great example of a middle power in the energy transition. Thanks, John. Now, we've been talking about a lot of countries other than the United States and Canada, and that's been intentional. I want to transition now over to the investment approach of Greenchip. You are global investors. You're certainly not focused on the large cap US equity market. Could you introduce us to the approach that you and the team have with regards to investing for those on the podcast who aren't familiar with it?
Sure. So, our whole investment thesis is based on the idea that the world is going through an energy transition, a transition away from fossil fuels to renewables. These transitions historically, like the transition away from burning wood to coal in England that kicked off the Industrial Revolution, they tend to take 100 years. We're in the early days of that another 100-year transition. That's our investment thesis. Over time, we've identified companies whose products and services address the challenges. If you want, they produce and sell the bits and pieces that get us through that transition. We currently have over 2,000 companies around the world identified that do just that, that produce those bits and pieces, whether it be the renewable equipment, water filtration services, advanced transportation, and the picks and shovels that make all those things possible, just as some examples. We're value managers. So within those 2,000 companies, what we're trying to identify are companies that are mispriced, that are trading in the marketplace at prices that we think are too low for what they're worth. And we've got a team of 5 that travel around the world and kick a lot of tires. Interestingly, your comment about Canada and the United States, we historically have been certainly underweight the United States. That's not because they don't have these businesses, it's because historically they've been more expensive. And I would argue not quite as good as the companies that we see in other parts of the world.
Great comments, John. And I appreciated how you specifically said that you're looking at companies that will get us through the energy transition, an energy transition that you said typically could take up to 100 years. You've just gone through the approach. Maybe this is the right time for you to introduce us to a specific company, a company that you've looked at, that you like, that reflects the types of opportunities that the team would consider.
Let me just start with, we like lots of companies. Like, I always hate singling out one, right? We're really excited about our diversified utilities right now. Power management semiconductors that run a lot of this electrification look really attractive. They're coming out of a down cycle. But I'll give you one name, and I'm going to pick a Canadian company. It's called Northland Power. It's about a $6 billion market cap developer of electricity generation and grid equipment. So Northland Power has been around a long time. About a year and a half ago, almost a year and a half ago, they selected a new CEO. Her name is Christine Healy. We've met with her a couple times. We think she's very impressive CEO, and she's a long time energy expert, working in all types, renewable, fossil energy, brings great experience. But these renewable energy projects are absolutely massive. They can be, hundreds of millions of dollars. They're very complicated, particularly the big ones. And the big ones that Northland have, 2 really big ones right now. They've got one called Baltic in the Baltic, just north of Poland, which is a very, very large offshore wind development, and another one in Hai Long, just off Taiwan. And We believe that Northland is historically been very good at executing these projects, but feel very comfortable that under this new leadership, they're going to be very disciplined in how they execute on this. And about November last year, they made a decision to cut their dividend. And the stock, as often happens with dividend cuts, the stock reacted very poorly and presented us with an opportunity to add to our position. The reason they cut the dividend was not, in our opinion, that they couldn't meet the dividend payout long term, but they wanted to de risk any kind of cash shortfall they might have in the near term. And it presented a bit of an opportunity. And the stocks performed really nicely since that low right after the dividend cut. But it's not just these big renewable energy projects. They have developed the largest battery storage facility on the North Shore of Lake Erie. It's called Oneida. They've purchased 2 new battery storage facilities in Poland. They've got offices in many parts of the world. And I just think it's really great that we have a Canadian company competing very well against global competitors in this massive market developing renewable opportunities with a management team that's very disciplined and looking for, minimum IRRs to maximize the return on these projects. So it's one Northland Power again that we're really excited about.
Great example with Northland Power. I also like that you have helped me segue to my final question because you finished off using the word return. I can't help but notice that the return of the green chip mandate in 2025 was up over 40%, I think 43% to be precise. And a question you often get is, has an investor missed the boat when they consider the opportunity right now?
Look, like, let's be upfront. The valuations in the market, particularly at the beginning of the year before, these military actions and whatnot, were not as good generally as they were a year ago. For a couple of years coming out of the Biden IRA, moving to the Trump administration, there was less interest, particularly in the United States, in supporting the transition generally. I think that's well documented in all the papers. The cynicism around our space crew and stock prices were undervalued. Then I think there was surprising growth that continued to the market, not to us, through last year. And there was also a pivot away from US growth to international value, and that benefited our portfolio last year. We hold just over 40 holdings. And when I look at our portfolio today, it's not stagnant. We've got about 9 new names from the beginning of last year in a portfolio of 40 holdings. As I said, we've got a team of 5 traveling the world. We've got about 100 companies right now that are fully modeled. They're not all ready to go into the portfolio, but we've got a pretty good list. And we're seeing enough of a discount between what we think it's worth and where it's trading that I don't think anybody's missed the boat. But I think the biggest story for us is the future relative performance. I feel like investors are increasingly going to pay attention to value of companies as opposed to just a growth story, or certainly a low capex, digital, financialized group of companies. Our businesses make things. They're built with molecules. And I think that is much more where capital is going to be focused in the future, particularly coming back to where we started with energy security, coming into a new era where governments are increasingly worried about energy security. They're going to have to, like our prime minister said, Mark Carney said, build, baby, build. We've got to build this stuff. This is how we power the future. And I think that sets our strategy up on a relative basis quite well.
It's a great way to frame the opportunity. And as you've said throughout this podcast, the energy transition is at least 100 years. We might be barely 20 years into it. So certainly no boats have been missed. John, thank you very much for your time. That's all the time that we'll have for today's conversation. I look forward to having you again sometime soon on the podcast. Thanks again.
You're welcome.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.